I just thought I'd share something with you that has often come up in coaching and in boot camps, and it is a common problem for traders because they don't know how many indicators to use. So for example, if we take the Swiss yen chart here, you can all see this lovely low test bar here. If I just change it to markers, you'll see this low test bar, which for us comes up as a T wave. If I put on the 8 and 20 moving average, this would have been a valid setup. To go a step back, with the knowledge we give you, you can see the strength of the buyers, multiple buyers and very minimal sellers. So even if you looked at a naked chart, you could actually justify buying this with your stop loss here, entry here, and targeting a 2-to-1, 3-to-1, and even a standard 1-to-1. And you would have got that from here. The information was blatantly here, especially after this sideways area. But if we start to reintroduce the average and then the second average, you've got enough. We bring in a third average, a fourth average, and a fifth moving average. You can see there's enough information to confirm that we are buyers. What happens if we start to then add things like pivot points? If I put on a weekly and a monthly pivot, there's enough information here for you and I to decide that we want to be a buyer with just a pivot, because maybe we've learnt this through one of the workshops and we see that this gives us enough information to be a buyer, and this area tells us, well, actually, there's nothing to be doing here because look, price is below the weekly pivot. You can see that this bullish area still remains. What I want you all to avoid doing is what I would call an abuse of indicators. Sometimes we can do too much. If you were to chuck on the alligator, you can see the alligator's been customized to look like two white lines and this purple line. The alligator alone is telling you be a buyer, but then you go, oh, what about Ichimoku, Manny? I love an Ichimoku cloud. You put that on, we're still getting the same information. And then what if you were to throw on a MACD? You say, Manny, the MACD line is above the signal line, I'm a buyer. The summary is this: you don't need all this information to decide to be a buyer. You just need to choose through your testing, back testing and forward testing, which indicators suit you best. Perhaps it may be 3 or 4 indicators, but ask yourself, is this helping me make money or am I doing it for comfort? Some of you want 50 indicators on a screen just for comfort, but it's not doing anything for you. You're not even making any money. You're just doing the same thing. Make sure you've tested the indicator to see whether the indicator resonates with you. Does it fit in certain areas like this? If we go to silver or gold, things like that, when they were trending, what would that have looked like in these market conditions? You can see now we've broken beneath the pivots and the alligator. This area was more than enough for us to be buyers with pure price action, with just moving averages, with the alligator, with the Ichimoku, with a MACD, and with the pivots. So which of these suits you? Which of these resonates? I would say you want to be back to something at least with maybe three maximum, just for starters, and see what goes after that. So if you said to me, well, the Ichimoku and the averages are similar, I'll use those two, and then the pivots. The similarity I've just mentioned there is why I'm saying don't overdo it, because a lot of them are giving you the same information. The long and short of it, with no pun intended, is we are buyers or sellers, and that's all the information you need. So do some testing, question in your sessions with us, question these things with us and boot camps and stuff, and we can talk about it more. I wish you good trading. Take care.